Hello, I'm Alex Chartres, Investment Director and Co-Manager of the Total Return Fund at Ruffer. And today we're doing a whistle-stop tour of the horizon, how we see markets going forward and what we think the big questions facing investors are. And we're going to break this short presentation into two parts. First, we're going to consider why we think markets are in a period of regime change. That's a shift from an historically benign era defined by falling interest rates, low inflation, and low volatility to a much more challenging backdrop of rising volatility and inflation. Second, we're going to look at what investors could do to prepare for and prosper from this shift. Because if we're right about it, some of the most successful and widespread portfolio strategies of recent decades, most notably the 60-40 stock bond balanced portfolio, are in mortal peril. The good news is that there's still lots of time to act. But just before we get on to regime change, a quick word on why you might consider listening to Ruffer at all. Well, we are global, unbenchmarked, absolute return investors focused on protecting and growing clients' funds in all market conditions, including periods of acute stress. You can see our long-term performance chart here. We're in green, UK stocks are in blue, the balanced private client portfolio index is in orange, and cash is yellow. And you'll see that we've generated equity-like returns of 9% net of fees annualized over a quarter of a century, including positive returns in each of the three major bear markets, .com, the financial crisis, and then the COVID crash, outperforming stocks with significantly less risk, lower volatility, whilst also offering greater diversification. We're not correlated to anything we've yet found, so we add genuine idiosyncratic return to your portfolio. And crucially, we've achieved this record by identifying major market inflection points well in advance and building in the appropriate offsets. And that brings us neatly back to regime change. Because the full 25 years of Ruffer's existence on this chart has been in a world of ever lower rates, low and stable inflation, and little volatility. And that's been manna from heaven for most asset prices. This disinflationary era has been underpinned by several factors, most notably globalization, particularly the integration of China's vast and cheap labor force. Alongside this, you've had things like favorable demographics and technology, laissez-faire government policy, and monetarist supremacy. In short, it's been a Goldilocks setup for financial assets. But our central thesis has been for some time that a new, more volatile and inflation-prone regime is emerging, one that's going to be much tougher to navigate than recent decades. Now, partly that's because the build-up of debt over generations meant that an extended period of financial repression was all but inevitable as a form of stealth default on those unrepayable debts. In plain English, financial repression is just where rates are forcibly suppressed below the level of inflation, and that erodes the real value of outstanding debt. But it's also because, with rates already at 5,000-year lows, governments would inevitably have to step in with more activist fiscal stimulus when the next crisis hit. Finally, it's because seismic changes in politics and geopolitics, which threatened the deflationary order, were also building. Well, COVID just accelerated everything, from a new Cold War between the US and China, political upheaval, a shift from a focus on cost of supply to the security of supply. Just think about the recent vaccine rows, the debt crisis, of course, also growing, and the arrival of monetary fiscal fusion, that's their helicopter. Now, politicians have got hold of the magic money tree and they're shaking it hard. Just think about Joe Biden's first 100 days in office. He's already proposed $6 trillion of additional spending. First, more COVID stimulus, $2 trillion, thank you very much. Then the infrastructure bill, another $2 trillion. And now he's talking about the American Families Act, another $2 trillion. So taken together, we think these factors could create a very different market backdrop, one which is more volatile and inflationary than investors have been used to for a generation. Now, this presents a huge asset allocation challenge if you want to protect against a regime shift, because traditionally safe assets, in inverted commas, to us look very vulnerable even before you consider higher inflation. Conventional bonds have been a core offset in many portfolios for decades. In fact, for 40 years, you've had equity-like returns with lower volatility, and better yet, they've gone up when equities have fallen. But from here, you know you're not going to make those kind of returns, simply because you need yield to compress to make gains with bonds, and with yield so low, that's already off the table. Long-term returns aside, as this chart shows, from their current starting point, bonds cannot even provide much of an offset. The green bars are where 10-year government bond yields are in the US and UK today. The blue bars show where those yields would have to go to for a balanced 60-40 equity bond portfolio just to offset a 10% decline in equities. For example, in the US, the 10-year bond yield would have to fall to almost zero to offset a 10% decline in the S&P 500. Now, this is possible, but not likely, and anything worse, of course, than a 10% fall in equities would require even more sharp declines in bond yields, potentially well into negative territory. And this is a critical takeaway. Maybe not right now, but over the next few years, investors will need to abandon conventional government and corporate bonds as a key hedge because they offer very low expected returns and limited diversifying or protective qualities. Even more importantly, the negative stock-bond correlation, which has made bonds a key portfolio offset, is only a feature of a low-inflation world. That's what we're showing you here. This is the rolling 5-year correlation between US stocks and bonds over more than 2 centuries. Now, Finance 101 teaches you to buy bonds to offset your stocks in a portfolio. But what you discover over the long run is that for most of history, bonds and equities move roughly in the same direction. The reason that they've had a negative correlation in recent decades is that with low inflation, central banks have been free to slash rates at the first sign of trouble, and that, of course, has been great for bonds. Now, the magic inflation number for this is about 2.5%. If inflation exceeds this for several years in a row, the stock-bond correlation flips positive, and your primary offset becomes a liability. We just had the worst quarter in 40 years for the 10-year US government bond. We think that could be just a taster of what's yet to come. So our industry is built on assumptions developed in an era of low inflation and falling rates, but it can be very different. This chart shows the performance of a balanced 60-40 portfolio through the early 1970s, when rising inflation, of course, drove bond yields up and equity multiples down. Over 5 years, that 60-40 portfolio was down 30% in nominal terms, and in real terms, after inflation, it was down more than 50%. Now, we aren't saying it'll be a straight repeat of the 1970s for many reasons, but we are saying that there are important echoes and that many investors aren't prepared for even relatively modest increases in inflation and volatility. So conventional bonds are likely to be fickle friends in a new regime, and so will many equities. The big question then is, what should investors do about it? Well, whilst we think that conventional bonds look like a poor investment from here, inflation-linked bonds look very attractive to us. We have 30% of the portfolio in what we think are the key asset for an environment of extended financial repression. Remember, that's just where rates are held forcibly below the level of inflation. That's actually the world we've been in since the credit crunch. It's just that we think it's going to get worse. Now, the key driver for the price of these inflation-protected bonds is the difference between inflation and interest rates. The more inflation exceeds rates, the more negative the real yield. And this chart is showing you what negative real yields can do to the price of the 2068 UK index-linked bond. Now, due to their long duration, they offer huge convexity to the scenario we're discussing. We know that central banks are determined to keep rates relatively low and that they are equally determined to stimulate inflation from current low levels. That's likely to mean the gap between inflation and rates should get wider, and that environment will be perfect for index-linked bonds, as well as for gold and gold mining stocks, which we hold alongside them. Now, turning to equity markets, the biggest winners in the low-rate, low-inflation world of sluggish economic growth post-Great Financial Crisis have been fast-growth stocks, often in new industries. Markets have put a premium on companies which have been able to consistently grow both top and bottom lines in a growth-scarce economic environment. But if nominal economic growth accelerates with a bit more inflation, more companies will be able to grow top and bottom lines, and the growth stocks of recent years will not command such a relative premium. Value stocks, by contrast, could prosper mightily as they tend to be more exposed to the real economy. We think it's likely that nominal growth is going to accelerate as a combination of massive government and central bank stimulus plus elevated consumer savings make their way into the real economy. Here we're just showing you the relative performance of value stocks versus growth stocks over more than a decade. Value's had a small rally recently, but there's a lot left to play for, as you can see. But investors have lived in a bubbly era of ever larger credit and asset bubbles and busts, fueled by ever lower rates and growing stimulus. First, of course, we had .com, then 2008. Last year, COVID crashed markets, but elicited the mother of all stimulus responses. And this, of course, has lifted asset prices to yet new highs. But market valuations built on low interest rates, low inflation expectations, and buoyed by record stimulus are clearly vulnerable to a surprise in any of those supporting factors. For example, if it looked like the Fed was going to hike sooner than expected, that might spook the market. Add to this undeniable signs of froth in some corners of financial markets. Think about the SPAC craze earlier this year, the GameStop saga. We're showing you a dramatic billboard from that here, media coverage of the crypto boom and so on. And we think it's essential to maintain powerful tail hedges against the very real potential for significant further volatility. Now, because as we've already seen, conventional offsets are so expensive and themselves therefore risky, we think you have to pay to have real protection in the shape of derivatives. Most of our derivative protection is focused on corporate credit markets at the moment. These look particularly distorted. Yields are back to pre-COVID lows, providing little compensation for historic default rates or inflation. So overall, it's an historic time to be investing. We think that a benign era is ending and being replaced by a much more challenging one. COVID's just accelerated this shift. It's not going to happen overnight, but it does mean fundamental changes to received market wisdom and huge new opportunities to boot.
Alex, inflation risk was a core theme of your presentation. Now, many people said QE would be inflationary after 2008, but it wasn't. What's different this time?
Well, first, because after 2008, fiscal policy went into reverse. Think austerity in this country, for example. And it was left to central banks to do the heavy lifting with monetary policy. Now that central bank stimulus got stuck in the commercial financial system, which was also pulling credit out of the real economy. This time, both monetary and fiscal policy are on fast forward, and the commercial banking system is in much better health. And then finally, because some of those other longer term shifts that I talked about in the presentation are much clearer. For example, a focus on security of supply, which implies less focus on cost. So the whole picture looks pretty different. But I'd also add, don't be surprised if inflation jumps later this year and then subsides shortly afterwards. We aren't saying this is an overnight change. We are saying that the oil tanker is turning and that you want to get out of the way. The good news is that investors have plenty of time to do something about it.
What would change your outlook? Why might inflation remain low and the existing regime continue for longer?
Well, anything which appeared to reinforce rather than undermine the disinflationary settlement of recent decades. So if US-China tensions disappeared tomorrow, if governments abandoned their magic money trees and retreated to austerity, if government policy remained laissez-faire rather than increasingly interventionist and so on. But none of these things seem especially likely to us, let alone all together. And we think that it's a question of when, not if, because if disinflationary forces do keep inflation low a while longer, the politicians are simply going to inject ever larger amounts of printed money into the system. The only reason that they wouldn't keep doing that is that inflation had already shown up. So our bet is that it shows up sooner rather than later, now that governments have relearned how to co-opt the commercial banking system and central banks. History's very clear. There's no such thing as a free lunch in economics. Someone always pays, and we fear it's going to be the savers.
Aren't equities a good hedge against higher inflation?
Well, that depends on many things, how much inflation there is and how quickly it's rising, most obviously, but also crucially what your starting point is. If your equity multiples are already very stretched, as they are in many cases today, particularly in North America, you're more likely to lose money if future uncertainty rises, as it does with inflation. Now, historically, 4 to 5% seems to be the important threshold where inflation starts to become a problem for equities as a whole, but clearly some sectors and companies will be able to do much better, especially where they have strong pricing power.
You suggested the 60-40 portfolios on borrowed time. Can you expand on this?
Well, 60% stocks, 40% bonds has been a really successful strategy in a world where both have been going up over the long run, but more importantly have offset each other over the short run. And whilst it's been especially successful since the early 80s, lost decades where you lose money in real terms over roughly 10 years are quite common if you look back over the last 100 years. Even in our historically benign era, there was a lost decade from 2000 to the Great Financial Crisis. Now, lost decades historically tend to start with either bonds or equities looking expensive. Both look expensive today, and we think that whilst many investors appreciate the risks of higher inflation and volatility from here, not everyone appreciates how risky their portfolio structures may actually be, and that particularly goes for the tried and trusted 60-40.
Isn't a passive long-term buy and hold strategy safer and cheaper?
Well, we think that's unlikely from here. The post-credit crunch world has been one of very generous beta. In other words, just owning assets, the broad market, has been a great strategy, and understandably, many investors have gone for the passive buy and hold approach. But given where valuations are today, in the US, for example, we're right at the top of the long-run valuation ranges, and the challenges stacking up that we covered earlier, the road ahead looks like it will be one where alpha, once again, becomes much more important. Remember that the stimulus-fueled rising tide of the last 40 years has trained investors to buy the dip. But if those long-term market drivers are reversing as we think they are, this is unlikely to be so successful going ahead. Instead, you'll want to focus on what will work in a new environment, not what's been optimized for the one we're leaving.
Some markets look historically expensive. Are there any which look especially attractive at the moment?
Well, despite the headline challenges, there are always interesting equity opportunities around. We've got about 40% of our own portfolio in equities, and they're focused mainly on modestly valued, economically sensitive stocks and defensive value that we still think look very interesting. As a whole, the UK actually looks very compelling at the moment, with indices stuffed full of stocks that few have wanted to own for a long time. Think financials, energy, resources, and so on. The UK market's actually had a double discount, first because of those unwanted companies out of favour over the last decade, and second because of political anxiety. It's our largest weighting at the moment. Japan also looks extremely compelling. As a market, there's huge value on many fronts. So I think corporate governance is improving, balance sheets are being optimised, there's a positive structural trend for digitisation, IT capex, e-commerce and the like. Japan has long been a warrant on global growth, and you can buy world-class companies at relatively modest multiples, and we've got quite a few of them.